Right. Good morning, everybody. It's 9:30, so let's get this show on the road. And today we're talking about staff equity rewards. So, for those who don't know me, my name is Paul Davison, and I'm the Director of Business Taxes at PD Tax Consultants. We're in Leeds, West Yorkshire. There's a bit about me there. And today I'm assisted by my colleague, Aimee. And as ever, these slides don't constitute advice. They are merely myself, our firm, imparting some knowledge and experience into the ether for you to think about, not advice. So, a little bit about the order. We're going to finish at 10 o'clock on the dot. You've got busy days. Your mics won't be enabled at any point, but what you can do is you can send us some questions. So via the Q&A button, please send any questions you can to Aimee. And at the end of the session, about 10 to, hopefully, we'll have some time for Aimee to ask me some of those questions. So please get them to us as soon as you can, because the sooner you get them to us, the more chance there is of your question being asked. There's a poll in the middle, so get ready for that. And if your question isn't answered during the session, then we will make sure that we contact you after the session, possibly on Monday or Tuesday next week, to follow it up and to discuss that with you. Great. We're going to go through today the main principles of equity for staff. With the people who are attending are accountants and business owners, so we're going to try and sort of pitch it in the middle there, try and be as succinct as possible, which means that you might not understand all the points to your liking, you might not even agree with them, but what's going to happen is at the end of this there'll be something that's going to be twigged in your mind to think about, move it forward, discuss with other people, discuss with us, and it's going to help you to gain more knowledge and move it forwards, you're thinking. So, on to the actual topic. What is the purpose? There's four areas here just to go through as part of today's webinar. The purpose. What's the purpose of providing equity to staff? Tends to be incentivization, but there are other things. Structuring. How will the staff get the shares, and what type of shares will they be? Taxation. How are the staff members and the company taxed on the share rewards? And then finally, legals. What to consider when it comes to the legals and providing shares to staff. Important to bear in mind that we don't have time today to talk about share options, because that's a quite difficult and full subject in its own right. So there'll be another seminar about that later in the year, details to follow. And when today we're talking about equity for staff, we're talking about shares for private limited companies. Equity can take other forms, such as capital in a partnership, becoming a partner. And if you have any questions about that, that's fine. Please put them on the questions and answers, and we can deal with those at another time. But today is really about shares, because I think in this day and age, most businesses are run through private limited companies that we deal with. So the purpose, primarily to incentivize the staff member. We all know that good staff in key roles are hard to find and even harder to hold on to. So when it comes to incentivizing them with incentivizing them with shares, there's a couple of phrases there which business owners tend to come up with, fairly relevant. We don't just want to give the shares away. There's only so much of the pie to go around, and we only want to incentivize the key employees. We don't really want to offer shares to all employees, just the key ones. So there are a couple of things to think about, and that's fairly common. One of the good things about providing incentives through shares is it doesn't necessarily cost any money now for the company. It can provide a very solid incentivization in a different way, which is the provision of a piece of paper which gives belonging, recognition and ownership, not necessarily cash straight away. So that is a benefit of providing equity. But there's obviously only so much to go around, and on that list there's a number of reasons or time or points at which equity could be considered. So I'll let you just run through that list there, but they tend to be around recognition of performance. They tend to be around promoting share ownership of the company to that employee, motivation around that. But they're also around sort of succession planning as well, and aligning employee interests with the business. Succession planning, management buyouts, consider providing the real key people with shares now, which they can build on in the future, and probably buy out some of the existing shareholders. So it's sort of a stepping stone along the way to succession planning. So how do we get the shares to the staff? Well, there's 4 different ways of doing that. We can gift the shares to them outright now for no cost. We can sell them the shares now for either a full market rate or a discounted rate. We can set out sort of a non-binding roadmap where we say to the staff, this is where we'd like to get to. How we get there is not necessarily set on a piece of paper, but if we achieve this, that, and the other, then this is where we'd like to get to. And we're sort of working towards that basis. So a bit of care needed there to set expectations properly and not over promise. Or then the fourth option, which is give them options over shares, which is basically to say, here's a piece of paper that tells you exactly how many shares you're going to get, at what time, and based on what performance criteria need to be met before you get those shares. That's a share option. An option is not a share. It's a piece of paper that says you get the shares somewhere down the line. So which of these feels best to the business owner? I think at PD Tax we've dealt with all these types of potential options. And it depends on the situation at the time and what feels right to the owner. Do they want the employee to pay for the shares? Do they want to have the shares now? Or do they want to say, well, actually, you've only just started in this company. I'll give you an option, which means you don't have shares, but if you do well, and we all agree, in 3 years' time, you'll get some proper shares. So all those different options are valid. What types of shares will they get? This is quite a key slide, this, and I think it's worth spending a little bit of time on this one. Restricted shares. So a restricted share could quite easily be a share that has rights over dividends, but nothing else. So I would suggest that is not really a staff incentivization scheme. That's more of a remuneration planning arrangement with sort of tax consequences, tax mitigation motivations. It's not really an incentivization scheme to drive the growth. It's more of a remuneration arrangement, which don't tend to like that much. They could provide full shares, so they got rights over capital, rights over votes, but those shares are in a different class to the main owner. given the main owner a bit more flexibility. Again, that's good because you're giving them proper shares, but I think the thing with that is, though, that if the employee thinks, well, actually, these shares, I want to get dividends on these shares, and what it means is that I'm at risk of not receiving a dividend if these other people get dividends. My dividends might get shunted to one side. So that is clearly, it provides the main owner with more flexibility, but does it properly incentivize the staff member is the question. They can get full, and there's another option is getting full shares, but only on a sale. So do those shares really only give any value on a sale of the business? That's quite a common situation and a proper way of doing it. It doesn't give the employee ownership of the business while they're working in it under the current ownership, but it does motivate them to stay on and work for that cash if it's ever sold. That tends to be through an option arrangement, and as I mentioned, we can talk about that on the next webinar. And then obviously there's the full unrestricted shares, which will and should provide full incentivization for the staff member in the same class as the main owners. So we've got a little poll for you here. And the question is really, have you considered giving equity to staff members? And the answers are, number 1, no, I don't want to give away equity. Number 2, no, but we've never had any appropriate key staff. Number 3 is yes, but it seemed too complicated. Number 4, yes, we've done it and it's been a success. And number 5, yes, we've done it and it was unsuccessful. So I'm going to start the poll now. If you have any comments associated with your answers, please put them in the chat box to send to Aimee. So you've got 30 seconds to vote, starting from now. Trying to play some music, but I can't play it. I can't touch the button. Okay, that's polling over. Yes, those results will be released on LinkedIn and our YouTube channel later in the week. Right, so now music started. Right, okay. So on to taxation now. Taxation of staff equity. Obviously, this is a complicated issue, and this is why firms like PD Tax sort of tend to get involved in staff equity, because the tax is quite complicated. And what it can do, the taxation can actually lace the provision of the shares with a disincentive. Because what we're trying to do is we're trying to incentivize the staff by giving them shares. But if they end up with a tax bill on those shares and no tax to pay it and no cash to pay it, then that's a significant disincentive to them. So in essence, the provision of a share is a benefit in kind to that individual. But it's only a piece of paper, it's not actually cash. So, as I said before, unless they have that taxation could arise to them and they have no cash to pay it, so they're like, this is not what I expected. So it's important to involve the employees in the process. It's important that the employees understand their own tax position right from the very start, really, on this. So the tax treatment is actually quite simple in its basic format. The employee is subject to income tax probably not national insurance, on the market value of the share at the date of its acquisition, less the price paid by the employee for that security. So, and the individual is taxable at their marginal rate of income tax. They are required to put that benefit in kind on their tax return form for the tax year, and the tax is payable on the 31st of January following the tax year in which the share was provided. The flip side of that is actually the employing company will benefit from a corporation tax deduction for the same amount that's calculated in point A there. So in a quick example, if in the situation of a share being worth £2,000 and an employee pays £1,000 for that share, then typically the employee has a benefit in kind of £1,000, and they might pay 40% on that if they're a reasonable earner. So they're paying £400 of tax on that share. They will have a bit of time to pay that because they've got until the 31st of January of the year and afterwards to pay that tax. But consequently also the company does receive a tax benefit, and that benefit is a corporation tax deduction of £1,000 at 19%. So the company has a tax saving of £190. The employee has a liability of £400. So there's obviously a bit of a mismatch there. We want to try and get the value down. Generally speaking, the company could use some of that tax saving it makes to fund the employee's tax bill to some extent. Obviously, that's a decision to be made and discussed between the parties. So what is the market value of the shares? Because that's an important question. We know that the tax position is going to be based on the market value of the shares at the date of acquisition. And we tend to want to have a low value, as I said, because there's obviously a tax leakage overall here. So we want to keep that leakage down. One of the problems is that we can only agree the value with HMRC if we do an EMI share option scheme. So under normal situations, in the face of it, we can't get HMRC to agree the value. We have to have a valuation report done, a proper valuation report done, and filed on the company's books as appropriate. The valuation tends to be on a sort of a price earnings basis, because hopefully we've got company here that's starting to build, starting to make profit, so it's going to be a going concern. Obviously, if it's at the start of the company's life, there might not be any accounts available. So it's no accounts available, tends to be the case that the share's worth nominal value, because a minority shareholding doesn't necessarily have rights to books and records and management accounts. So the market value could be based on the first set of statutory accounts, which might not be filed for sort of 18 months after the company starts trading. So the preparation of a proper valuation report is going to be key. And it's also important to bear in mind that the company, the company does have to report the provision of shares to its employees, to HMRC itself, on an employment-related securities return. Just bear that in mind. Finally, the final sections on the legal aspects of the provision of shares. It's important that everything we do with these is documented properly. All the paperwork's done properly, and there's a proper paper trail for this. Clearly, the key stakeholders are the employees themselves, you as the business, HMRC, we want a proper paper trail in place so that if there's any questions about it down the line, we can say, this is what happened, it's all clear, no questions. And another key, a very, very important thing is the shareholders agreement. Very important. If they give shares to an employee and a few years later they decide to leave, there's a big bust up, they leave, what you don't want them to happen is for them to go away with those shares in their back pocket and say thanks very much. What we want to happen really is, and what's quite common with shareholders agreements, is that there's often a provision that says if an employee leaves for whatever reason, then those shares must be sold back to the company. And it's quite common to say if they do leave, then those shares are bought back for the price that the employee paid. Now that might not always be the case, because you might have an employee who's been there for 10 years or is retiring, and you feel, well, actually they deserve some value for those shares. That could be written into the shareholders agreement as well. And what you would tend to want to do also is to have a little provision that says how you calculate the market value of the shares if they are bought back in the future. Very important. Okay, so that's the end of the sort of the run through on Untitled Staff. I hope that's been useful and brought some of your thinking together. As I mentioned, we do have another seminar on the 4th of September at 9:30 regarding share option schemes. Accountants Toolkit seminar is on the 7th of August. Aimee, do we have any questions today that I can field for our audience?
Yeah, we've got a few questions. So first of all, if an employee gets restricted shares and then those restrictions are lifted at a later time, what are the tax implications?
Ooh, very good question. Yes, this is into technicalities here. So this is why tax people tend to deal with these types of things. If the restrictions are lifted, then that is effectively what you're doing there is you're providing more benefit to that for the shareholder. So the provision of the further benefit needs to be valued, and then that value again goes on their tax return form and is a taxable benefit. Obviously, the main question is, what is the value of the restrictions that are being lifted? There is some guidance, a little bit of guidance on this in terms of a restriction might be that the shares can only be sold back to existing shareholders. That's a restriction. If that one's lifted, that tends to be worth about 10% of the total share value as a guide. But otherwise, if a restriction's being lifted, we're going to have to sit down and work out what the value is of that additional benefit. Is it votes? Is it dividends, etc.? And try and value it, and then tell HMRC about it and tell the staff member about it. Okay, Aimee, any more?
Okay. Yeah. So if a director wants to bring in his daughter to do the bookkeeping for his one-man company and gives her shares, would the following work?
Good question. The provision of shares for employees and the benefit in kind that provides is based on the fact that they are getting shares on the basis of their employment. So the taxation matters I went over in these slides are based on people receiving shares because they've got employment. If the shares are provided because they are family members, and not because of their employment, then those rules do not apply. So the provision of a share to a daughter, a son, possibly a brother, don't know, but certainly to issue would tend to be outside of those rules. So if it was a daughter, and they were getting the shares because they were the daughter, and the bookkeeper wouldn't normally receive shares in that business, then that will be a tax-free receipt of those shares by the daughter, and she won't have to pay any income tax. There are issues around how the shares get from the mum or dad to the daughter, because that's a disposal by the parent. So that needs some thinking about. But gift relief for business assets might be available to avoid any tax, but you do need to think that through before, as part of the overall planning on providing those shares to the daughter. And as I said before, this all needs minuting, and I would think it's probably quite key in the minutes to say the reasons why the daughter is getting the shares. Hope that's been helpful. I think there's time for one more question, Aimee.
What are the tax implications for the business owner? Do these differ depending on whether they transfer their shares or the company issues new shares?
I think your Wi-Fi is a little bit. Amy, could you repeat that? Or
It's always on a Friday. What are the tax implications for the business owner? Do these differ depending on whether they transfer their shares or the company issues new shares?
sorry, I didn't really catch that one either. Sorry.
So, what are the tax implications for the business owner?
Yeah.
Do they differ depending on whether they transfer their shares or the company issues new shares?
Right, I see. So I think the question was, what are the tax implications for the business if a company issues shares compared to a company compared to a transfer of shares between an existing shareholder and a new shareholder? I think that's right. So there's two different ways of providing the shares. There's an issue of new shares, or there's a transfer of shares from an existing shareholder. An issue of new shares, the company will, if any money is payable by the shareholder for the shares, that money goes straight into the company. Something to bear in mind. But it's still a provision of a benefit in kind. So the taxation position is exactly the same to the employee. They'll receive a benefit in kind and pay tax on that. If we have the transfer of existing shares from an existing shareholder to a new shareholder, then the employee has exactly the same position, because they're potentially receiving a benefit. They may have to pay tax on that, but the shares moving from somebody to somebody else. So any monies paid by the employee go to the disposing shareholder. So the person who's selling gets that money, but they will then have to either pay tax on receiving that money, or possibly be treated as gifting those shares to the employee. And again, if there's a gift, we should be able to avoid tax on that gift by the disposing shareholder through gift relief. So the tax implications are actually quite similar on the issue of new shares compared to a transfer of existing shares. It's just the mechanics of where the money goes to that's key, and also the dilution of existing shareholders. Right, thank you very much, everybody. That's the end of today's seminar, and I hope you found that useful. Thank you.